Hi, everyone. My name is Mario Simonian, founding attorney of Esco. And today, what we want to talk about during this video is what Amazon sellers should know about their numbers, right? And you may be thinking, well, you're an attorney. Why are we talking about numbers? Why are we talking about financial reports? To be honest with you, it's sort of a selfish reason, but just because it's selfish doesn't mean it can't benefit you, right? Um, a lot of Amazon sellers will, I'm not saying everyone, but I've seen several that'll talk about their revenue, right? I made $1 million. And what they're really talking about is revenue. And so I think it's super important for everyone to understand how finances work, how the different financial reports sort of come into play to help you run your business. And it's great that you're making $1 million, but at the end, what you're taking home to your family for your kids is what's really important. And if you don't know your numbers, then when it comes time to hire an attorney or even hire a bookkeeper or CPA, then you're sort of just looking around for money instead of being able to budget that beforehand. So when the time comes to hire an attorney or any other professional, then you've got money set aside, right? Instead of just hiring the cheapest attorney or cheapest CPA, right? So super important for the health of your business to budget everything out and really know your numbers and review your numbers on a monthly basis. So let's start with this. Today, what we're going to be talking about is income statement, or otherwise known as a profit and loss statement. Okay. But 7 reports, just going to my notes. There's other reports that are just as important for running your business, right? So we've got the profit and loss statement, otherwise known as income statement, balance sheet, cash flow statement, accounts receivable or AR aging report, accounts payable, and budget versus actual. Okay. With respect to the budget, I always reserve towards the end of the year about a week or two for me to create a budget and enter that into QuickBooks or send it to my bookkeeper for him to enter it into QuickBooks. And then really you're running off of that. But today, what I want to talk about is a profit and loss statement and really dive into that. And just when I say dive in, we're not going to get into anything super advanced, but just going over the basics, what you guys should know at a minimum. Okay. So what I've got here, let me just share my screen. I've got a dummy report that we got from one of our clients. And let's assume this is Acme Corp. And this is the previous years. So this is the previous years, but otherwise you may be seeing this on a month-to-month basis. If you're in, for example, if this was 2023, then you wouldn't be seeing this information. You would only be seeing it up until April. So if you're only seeing April, you're comparing that to your budget and you see that you need to make changes, it's easier to do so, right? Think of this as sort of your financial dashboard. And what can you tell from a P&L report? So a couple of things, right? Here, I mean, I think the bookkeeper has done a pretty good job of creating these chart of accounts. That's what these are called. The numbers assigned, think of those as just account numbers that are assigned to each category of each category or the chart here, chart of accounts. Okay. And if you're looking at other P&L reports, numbers may be different, right? You may see one that has this starting at, I don't know, 1,000, right? And then each one of these are numbered accordingly, but those really, they're arbitrary. So what can you tell? So we see that they're an Amazon seller. Great. We also see Shopify. So we know that they've got a Shopify store. And if you scroll down here, what else do we see? Shopify website. So we've got that warehouse. So not only are they using Amazon FBA, but they've also got a warehouse. Stripe fees, again, that goes back to Shopify. That's probably what they're using. Okay. And then advertising. So we see all of the channels that they're advertising on: Amazon ads, Google ads, Facebook, influencer promo, and web marketing. Not sure what that is, but again, we see some money there that was spent in September. From there, we see that they've got contractors, so they've got VAs, photography they've used before, and glad to see that they've got a category dedicated to legal and professional services, right? I don't see any legal fees here, and we don't have their budget. I don't even think this client here has created a budget, but hopefully they've got a category for legal fees and they can budget and keep a percentage of their monthly money or monthly income in a separate account so they can use it for attorneys and legal fees. And we see, so up there we saw VA. We also see payroll expenses, right? Right there, highlighting it. So what this tells me is officer salary, so the owners are paying themselves. Okay, so $2,000 a month is what he's paying himself, or if he's got partners, they're splitting that up. And then we see a big, large payment of $40,000 in December. Okay. Taxes, glad to see. And then at the end, we see net income. So that's how generally you could look at it to sort of orient yourself to their report. Okay. I've got this highlighted. That's just total income. So it's their Shopify sales and Amazon sales minus any other returns or refunds that they may have. And at the end of the year, 532,000 and change is what they had. Next, what makes it also easy for you guys to look at is I went ahead and color coded just so you guys see the three sections. The main three sections of a P&L report or an income statement is income, which is your revenue. Then you have cost of goods sold, and then you also have expenses. Cost of goods sold, or COGS, is not included in expenses, okay? So cost of goods sold is separate. So I've got that highlighted in yellow. You'll see that. And what does this include? It'll include the money you pay to your supplier or manufacturer to purchase the goods, any warehousing, any freight that you pay to get it over here or get it into a warehouse. That would be considered COGS, or cost of goods sold. And then expenses, this is where you would have your marketing. This is where you would have any staff, any contractors you pay, such as bookkeepers, attorneys, any bank fees, any overhead. So if you've got offices, if you've got autos that you've got for the business, office supplies and taxes all go in here. Even meals and entertainment, you'll see that. Here we see they spent $290 last year for meals and entertainment. Usually that's higher, to be honest with you, but I only see 290 here, okay? And then any website fees, things like that. So hopefully this helps you sort of see the big chunks, the big parts of a P&L report, okay? And every Amazon business or every retail business will be laid out like this. But obviously, if you're looking at another P&L, for example, if we were looking at the P&L report for my law firm, this part would be missing because we don't have cost of goods sold, right? Or any service-based business would be missing COGS, okay? And really what the COGS is saying is, here they had $41,000 in sales in January, okay? And it cost them in COGS, or the purchase, the cost of their goods was $9,286.87. Okay, so this is what this is telling us, and the shipping supplies and so forth. So now that you understand this, let me show you something that's not highlighted. So after you see income and cost of goods sold, you'll see gross profit. What gross profit is, it's just your income minus COGS, or cost of goods sold, will give you this, okay? And again, if I click on this formula, you'll see it right there. It's the total income, which here was $48,194 minus $23,000 and change, will give you $24,000. So before we look at expenses such as marketing or overhead, any staffing, that's what their gross profit is. Okay, that's right there. And then for the year, $218,000. Now, once we look at expenses, now we're also going to minus that. So another way to say it is P&L, the main chunks, it's income. Then we subtract COGS. Then we're going to go ahead and subtract expenses. And then this will give us our profit. Okay. So again, going back to what I said earlier, when people say I sold $1 million on Amazon, or I sell $1 million a month, or I sell $1 million a day, they're really talking about income here, right? So even if it's, see if I added enough zeros, if that's $1 million, we don't know what their COGS are, we don't know what their expenses are, and obviously we don't know what their profit is, right? But worst case scenario, this could be $900,000, and this could be, let's say, $95,000. And if we take $1 million and then subtract their COGS and subtract this, they're only left with $5,000, which is a net profit margin of 0.5%. 0.5%. Okay. So people always like to talk about this. What's really important and exciting is that right there. Okay. So those are the three big chunks of a P&L report. Next, let's talk about what you can add to these P&L reports. So what I always like to do is take a look at the ratios, and I've outlined some ratios here. So what did I do here? I want to look at the COGS, the $314,000, and then divide that by the total income of the 532, and then see what percentage of my income is going towards COGS. And here you'll see that's exactly what I did with this formula. So that tells me that from the $522,000 that this business made, 58, almost 59% of it went to COGS. Okay. Now, gross profit margin, 41%. Again, gross profit margin is just going to be 532 minus 314, and what's left is 41%. Okay. In the next slide, we'll also talk about setting targets, which really goes back to setting a budget. And I've highlighted those main sort of key indicators or key financial metrics in yellow. But this is something super easy that you could do when you're looking at a report. QuickBooks also has a feature where you could turn this on and run a separate report that'll give you all these percentages. But if you don't have it, if you're still doing your books on Excel, this is something you could do very, very easily. So here we see 12%. Almost 13% spent on marketing, and then staff. This is the VA 6.74, 1.22 for professional services. Payroll. This is what the owner or owners pay themselves. This is the 63,000. So 63,000 is 11.83% of the total income, and then total expenses 37.5%. And then net operating income and then net income. So again, net income, meaning their profit at the end of the year after all the expenses, after all the work that they did, was 4%. 4% of the $500 and something thousand that they made. Okay, 4%. Now, doesn't mean that that's all they took home. That's just the net income, right? Here, they also took salary. So they took payroll. So we got to take that into account too. And now you can say, you know what, maybe it's 15%. Something I really like to do, I call it TOB, or it's called TOB, total owner benefit. If they have their automobile, or if they have certain expenses that are legit business expenses, but they consider that a total owner benefit or an owner benefit, I would go ahead, and what I do is we've got a tagging system in QuickBooks where we would tag those. So at the end of the month or at the end of the year, I know how much of my total owner benefit is really there, or how much I really took home or actually benefited from running this business, right? So next, let's talk about some targets that we mentioned. So
Hello there.
one thing, hey,
Sorry to jump in.
one thing that I'll say about targets is there's some people that'll say, you know what, you should only spend 60% on COGS, or you should only spend 25% on total expenses, so you could be left with a 50% profit margin. That's all good and well, but I'm not a fan of sort of hard line rules, right? And I'll tell you why. For one business, a 25% target for expenses may be perfectly fine. And let's say out of 25%, they want to dedicate 10% of that to marketing, right? So total marketing out of the 25%, they want to dedicate 10% here. That's perfectly fine. But then you may have another company that's in growth mode and they want to spend maybe 15% or 20% on their marketing and instead take a cut from here, right? They may decide, their business plan may call for, you know what, I want to take 0% home because my goal is to go ahead and not take anything home from this business. But for the next 3 to 5 years, I'm going to go ahead and run it and eventually exit by selling. That's when I'll reap the rewards. That's why I'm not a fan of hard line or red line targets. Okay. But again, for each business that you're running for your business, you should have targets, right? You should have an idea of how much you should be spending. Because then when you're looking at your ratios, you can know whether you're on target or not. For example, if we said that our target here was 10% for marketing, then we would know, hey, we're actually spending a lot more. Where can we cut from, right? How are Amazon ads performing? Where are we really getting the most bang for our buck? Is it Amazon ads? Is it Facebook ads? Is it Google ads? And then you can make adjustments from there. Again, the idea is that you're reviewing this on a monthly basis. So if we're in, let's say, March at the end of Q1, and we look at this and we say, you know what, we've spent 12% on marketing and our target, our goals called for 10, and we're really not seeing the growth, then it's time to sort of adjust and plan for the next 3 quarters or the rest of the year. That's why, again, targets are helpful, but it's sort of dangerous if you have hardline rules for where the target should be and what the target should be without an understanding of what the goals of the business are. Okay. Final tip for the Spark line. This is something super simple you can insert. The way you would do it is if you just hover or select on a cell, and if you go to insert, some of them will have it. If you don't see it here, what you can do is just go to the top here and type in Spark, and Spark line will come up here. And then what you're going to do is select the date range. So for example, if we could select this right here, obviously don't include the total, but just each month. And that'll give you this, right? It's sort of a mini chart or a mini line graph. And why is this helpful? It's sort of easy to see when the income's coming in. Here I could see that probably Q3, they have a large month, right? Without even me looking at this over here, at the numbers over here. Because look, here in August, they have a $99,000 month, where on average, they do around 43,000. That's what that big spike is in sales. Okay. And the same thing with here. Let's say if we're looking at marketing, looks like in January, early on in the year, they do a lot of marketing, or at least expenses. And then it sort of just dips. It's sort of like you, right? So this is good to have for you to have a visual sort of idea of where they are. And then contractors, again, just looking at this, not even the numbers, it looks like it's all over the place. So if I'm looking at this, my question is, what's going on? Are you guys having a lot of turnover, right? Or did you guys have them part-time and then change them to full-time? What's going on? Why is this so staggered or so volatile? Because usually for staffing, it should be pretty even, pretty steady. So that's another sort of feature in Excel I like to use when I'm looking at this. Okay. So with that said, what can be done? So a couple of things, right? If we're talking about increasing revenue and profitability, if you're in the Amazon world or sort of retail world, there's a handful of things that you could do. Number one, you could go ahead and add products, new products, or a product line to your brand or to your business. And the idea is that those would get more sales. Obviously, that idea has its own disadvantages. You're going to have to invest more capital. You're going to have to invest more capital in the product and marketing. And obviously, hopefully you've done the research well. Hopefully you've done a good job negotiating the purchase price with the manufacturer. Something else you could do is go ahead and sell more units of the products that you already do have, right? And really what both of these boil down to is something else that you could do is sort of combining both of them, is expanding to a new marketplace to acquire additional customers, whether it's Walmart, whether it's Etsy, whether it's Shopify, right? Your own website. If that's sort of increasing revenue. Something else you could do is look at eliminating expenses. What I do about twice a year is look through the expenses and see what software are we not using. I remember there was a time last year where we had 2-3 subscriptions of the same software, right? And again, you're not going to find anything that's like super large expense, but it's going to be focusing on the small expenses or small items that you no longer even use, or you can find a substitute where you could get rid of it, and those smaller items will obviously add up. Something else you could do is go back to your supplier and negotiate a better rate. Okay. Sometimes when you start with a manufacturer, you may not have the best relationship. And something that I know has worked well is visiting them. The $2,000-$3,000, whatever you're going to pay to fly to China or fly to India to meet your manufacturers. Usually, if you can be smart and strategic about it, the money that you pay will go ahead and be well worth it, because you could go ahead and usually negotiate a better price when you meet them face to face, when you're sitting across the table from them, right? And then last point is increasing the price of your product. And some people might say, you know what, how do I increase the price? If all my competitors are selling at $10, how can I sell it at $20? Or how can I sell it at $15 or $12? Again, every product's going to be different. But what I always like to do is, if you're going to increase the price, the client or customer better get something more in value. So the question to you then is, how can you increase the price by increasing the value or perceived value of it, right? Is it bundling the product, or is it maybe including some sort of ebook that the client deems or perceives to be a lot more valuable than your competitor who's only selling the product at $10, but now you're selling it at $12 or $13, right? So those are things that you could do. Again, last thing is, you need to have a financial team, right? Make sure your bookkeeper, make sure your CPA, make sure your tax strategist, financial advisor are all on board. Usually, I always suggest getting those people on board before you're there at a point that you could even sort of have enough money to use them. And again, all 3 of those people or 4 of those people can be the same or 2 people, right? But as you grow, that team's going to go ahead and expand, and maybe each person is going to have that separate role. But these reports, you could go ahead and pay your bookkeeper, but unless you're looking at them, unless you're making decisions based off of those reports, they're useless. So I'll leave it at that. Okay. If you're, we're going to have this on YouTube and a couple of other things. So go ahead and subscribe if you want more videos like this. Usually 99% of the time we're talking about legal, we're talking about Amazon legal, we're talking about IP, but I thought this was super important to talk about finances and just the basics of it, because so many of the clients, super successful companies they're running, but they don't understand the basics of a P&L report or just financial reports. So I thought this would be the beginning of maybe more to come. Okay. So go ahead and subscribe, go ahead and like the video, and we'll see you guys next time.